So we finished strongly on the S&P 500 here this week, heading into options expiration today. I'm going to break down the significance of this expiration and what that means, what we've seen before here in the recent past at these expiration dates. I'm also going to break down what's driving this market. Why are we so bullish, and what's not bullish? Right? What's not participating? And what that divergence mean. When have we seen a divergence like this before? So I'm going to break all that down in today's video. I'm also going to talk about some other asset classes that are not participating as well in this bullish trend and what that can mean. And then we're going to take a look at a stock that hasn't been as bullish as some of these other stocks during this little rally, and we'll talk about a way to trade that one, as well as what types of stocks we can trade if we want to continue to be bullish as the market, if it continues a V bottom from here back to all-time highs. So we're going to talk about that as well. So let's go ahead and get started. Today is Friday, April the 17th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and take a look at the S&P 500. Look at this rally heading into options expiration here. Big jump from March expiration. March expiration, we had this, that's where the big drop. And you remember we had, we were getting less volatility and less volumes on these drops heading into that expiration. We had one day after expiration with the cluster, and then we rallied. You also notice here going into February expiration, that's where we got the runaway gap to the downside, and this is where we got the runaway gap to the upside. So now the question is, what is this expiration? Obviously, there's been some interest around this expiration. Ask any options trader in Gilead Pharmaceuticals yesterday before that announcement came out, or even for the last week or so, apparently in Gilead. There's a lot of interest in today's expiration for that stock, and so it'll be interesting to see this. What March, how February and March pretty much produced, some interesting pre-expiration action, and then of course the quick reversals post-expiration. Are we going to get something similar? Obviously I don't think we'll get that kind of a drop coming out of April expiration, but can we fill in some of these gaps that we've had along the way, including all the way down to this 2,500 level, and fill in that gap? That's definitely within the realm of possibility, of course. The intermediate line still not above 80. It's rising, it's bullish, and that's good. We got dark green shading. We don't have the green line yet. We do have the green line, however, and not in the Nasdaq Composite, but in the Nasdaq 100, which is obviously more concentrated in the 100 biggest companies in the Nasdaq. A lot of these names are the companies we've talked about before that have been leading the market higher. In my premium technical analysis class I had today, I remember all monthly subscribers get access to that class, and the recording is up. So if you want to check it out, you can subscribe. Even just for a month, you can subscribe and get access to all of our recordings. But in our technical analysis class today, our premium technical analysis class, I talked about the effect of this concentration on these in the S&P 500, in the Nasdaq 100, and what to expect out of that. So if that's something that interests you, like I said, you can sign up anytime and cancel anytime, and be able to get access to all of our archives. We've taught classes now for over 100 weeks, so that's a lot of content you would have access to. And you got a lot of time to be able to watch, considering a lot of us are just at home right now. So I'll show you later the link to be able to subscribe for that monthly plan. But so again, it's not the composite that's doing so well. It's the Nasdaq 100 that's doing really well. The S&P 500, the Dow, the S&P got above the 50% mark. The Dow Jones Industrial Average not quite to the 50% mark. The Nasdaq Composite's well above. In fact, the Nasdaq Composite's actually flirting with the 62% mark, right? So if you were to come over here, sorry, let me do this, and then I'm going to right click on this and activate, and just line up these lows a little bit better, and line up this high point up here. There we go. So you can see we are sitting right at the 62% Fibonacci retracement, the top end of this zone on the Nasdaq Composite. And then, of course, the Russell 2000, which has been the most bearish out of all of them, which actually, despite today's rally, has dark pink shading again, which means the intermediate line is turned down and still has a yellow line, right? We still haven't, the trend doesn't change until you get dark green shading and a green light, right? Even just a day or two, but you can see a bearish trend, it doesn't change. Here we had a day of dark pink shading and red line, and that lasted a whole day. So it's got to be more than just that. For a trend to change. So that's kind of what we're seeing right now in the S&P. Is, you know, we've got, you know, I mean, look at the near-term line bouncing up from a bullish low point, but it's like, you know, you look at the last near-term low right here, and you really think that, do we really think that that is as good of a near-term low point as this one is, where it was a nice pullback, and we had a couple of days there, and then we bounced off of that, and the near-term line rallied. Pretty obvious near-term low point here. Not so obvious near-term low point here, which means this near-term high is probably not going to last very long, especially considering it can be setting up already for a divergent high point here on the S&P. And of course on the Russell 2000, same thing. You know, a little bit more of a pullback here and a little bit of a bounce. So the question is whether we're going to bounce enough to get through these highs at 1250 into the retracement zone, right? This whole zone's of resistance areas. Again, Nasdaq is at the top end of its resistance area. Is it going to be able to get through that resistance, or are we going to continue to follow the trend to the downside, which, you know, according to the pattern, market forecast patterns, you would suggest the latter and not the former. All right, so before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below this video if you're watching us on YouTube. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. Number two, you want us to do a video again Monday. Quick way to give us feedback. If you don't like our videos, you don't have to click on anything. But if you do like and you'd like to see these, let us know. The more you click on it, the better it is for us. One click, you can do that right now while you're watching. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website here, we invite you to check out the things I told you before, that monthly plan. This is where you can get some access to it. If you click on the word pricing up here, it will show a comparison of both of these individual plans, so you can see what you get with the monthly plan and what you get with the premium plan. The premium plan gets you access to all of our premium resources that are available, including our chart scripts and things like that. The monthly plan gets you access to all of our classes except for our 2 Q&A sessions. Those are for premium subscribers, but you also get access to our Market Outlook live trade reviews. So we go back at all of our old trade ideas that we do on all these Market Outlooks, at least the ones that I do, sorry. And then I go back and review all my old trades, and we manage those trades all the way to the time that we close them. We manage them as part of a portfolio instead of just individual trades. We manage them together with other trades. So you kind of get a good education out of that. That's the number one thing I get asked about all the time about these videos is, hey, can you go back and look at some of these trade ideas you did in the past? Well, that's what we do every time. Every time I do the Market Outlook video, I do this first 3:30 Eastern time here on our website. So, and you can get to it also right here with that link. All right, and of course you get access as a free subscriber to our Market Outlook forum, and there's where you can get to that as well. All right, we also invite you to engage with us on social media. Hit that heart and it opens up a new window. You can like today's Market Outlook tweet there. Hit that thumbs up. Again, the more you engage with us on social media, the more they'll promote all of our content to you that we produce on those platforms. They don't promote all the content that you follow from the accounts that you follow, because that would be too much. So they have algorithms that only promote content that you from accounts that you engage with the most. So we try to make that really easy for you to do here. All right, back to our charts today. You can see a nice, good bullish candle again. In fact, we came really close to closing above last week's high point, the Hakinyashi close. 28.18 was the high, and our close here was 28.14. Of course, our close in the actual index was 28.74, which means that we're going to have a really bullish candle next week too, because next week's open is going to be the midpoint of this body. So from a Hakinyashi standpoint, we're going to have a pretty decent size, pretty decent candle here. We'll see how things end up and whether or not we end up getting and staying above the 50-day moving average. You can see that on the S&P we have broken up above. Now, I mentioned before too, of course, the Dow Jones Industrial Average, you can see it's also just a smidgen above its 50-day moving average. The Nasdaq Composite, when you look at its regular candle, is not only above the 50-day moving average, it's back above the 200-day moving average. So that was a really, really quickly. In fact, the QQQs are even stronger. The QQQs have already formed another golden cross. So now it's like, and talk about V bottom, there's your V bottom right there. And it's in a very limited number of stocks from these really large mega cap type tech names in this Nasdaq 100 area. And it's not all tech names. There's Pepsi's and Costco is in the Nasdaq 100. So a lot of big names already close to their all-time highs, because you can see we're not very far down now below that, and we're getting close up to that runaway gap actually. So big time reversal. It's PPO, which is a measure of the 50 to 200 day moving average. This will show you it never really got that bearish. The S&P, the Russell 2000, you can see it's got the worst PPO and it's still falling, and we're not even close to the 50-day moving average on the Russell 2000. So it shows you a big stark difference. In fact, the Russell 2000 is giving us a really bearish candlestick pattern for the week. Long lower shadow and hanging man type of pattern here. So it kind of says, okay, which chart do we trust here? There's a big discrepancy between the Nasdaq 100, which never got bearish, which we dropped down, but we dropped up. We were down in 1, 2, 3, 4, 5 weeks. We made a round trip below the 200-day moving average and back above it, and now we're staying above it with the golden cross. Versus the Russell 2000, which has gotten below the 200, has stayed below the 200, it's still below the 50-day. And still has a very, very low PPO. So when you look at the S&P 500, which one's going to play out, right? Are we going to V bottom back up into here? We've talked about before how, if we were to get back up to these highs, you'd probably get really safe haven mode here. Because again, if a 34% drop in 4 weeks can't produce a good base, long-term base, then that's going to be a concern. In terms of, especially with earnings dropping and price back up to all-time highs, PE ratios are going to blow through the moon on that, and it's going to limit return expectations in the intermediate term, especially for like a forward PE. You can see his PPO got relatively went down as up the last couple of weeks, but not get down as much as the Russell. Of course, the Dow Jones Industrial Average, again, flirting with the 50-day moving average, not nearly as bullish as the S&P is. So where are we? Are we as bullish as the Nasdaq? Are we as bearish as the Russell 2000? Or somewhere in the middle, like we're seeing like on the Dow Jones, for an example? That's the million-dollar question going into next week. Let's take a look at the 3 green arrow chart, and you can see we got 3 green arrows, not surprising, on the S&P 500, and you look at the 2-line version here, and you can see the stochastics is flirting with getting below its moving average. We talked about that before, but still above a rising 8-day moving average, and 8 days still above the 17. That is the SPY. IWM had actually closed below the 8-day briefly, come back up today. And the MACD histogram, which was falling, has kind of stalled its fall, but the stochastics is still below its moving average. So, again, how much can we trust this rally that we've had, specifically in QQQ, heading into this options expiration? Look how bullish the QQQ is. The 8 and 17 well above the 30, and pulling away the MACD very high. The histogram is falling down barely. And the stochastics moving average is at a pretty strong level. So big discrepancy between, again, QQQ and IWM, whereas MACD is barely getting above 0 and having a hard time making any headway, and its moving average still hasn't crossed above 0 yet. All right, let's take a look at the intraday chart for the S&P 500. There's that. Look at that rally heading into the close. There's the gap today that didn't get filled in. Again, probably a common gap because, again, not very much volume, not breaking through a significant level. So it makes it very likely we fill that in. this common gap in. We have now filled that gap in, the upside, but we filled it in with overnight trading. So it'll be interesting to see if we fill in both of those again back to the downside, even with this gap too that we filled in over there. So we'll kind of see how things play out into next week coming out of this options expiration. Of course, there's a volume gap here too between this volume node about 280 down to about 260. So there's an opportunity to fill that in. Probably not drop, probably not gap down, obviously, but work our way in filling in that gap to the downside. But again, support down here at this gap and another area of support once we do fill in that gap. So I'm not looking for us to break down. For obviously anything can happen, but there's a good likelihood that we fill in that volume gap at least down to this 260, if not down and filling in that first before we get going again back to the upside. That would actually be a little bit better for the kind of intermediate, like 1-2 year outlook for the markets, that we do that instead of getting this type of quick reversal that doesn't have a whole lot of support below it. It's not surprising to see the range today way below the average. Here, let's go to the 3 green arrow chart here. So the range way below the average, but you do have to keep in account the gap. So we closed at 279.10. The low was 282.40. So we had a $3 gap, but still, I mean, that puts us to 8-point range. Still very small. The volume picked up a little bit. Options expiration, little volume there, but still well below the average. So 146 million 8-point range. When you look at the ATR. There's 8 points, so it's still bringing the line down. 146 million is down here, so still bringing the line down. You notice we're not to the 3% mark yet on the ATR, where we can feel really good about being the low point, right? This being the low point. When we've had this much volatility, usually the low point occurs after this gets down to the 3% mark. If you take a look here at the RSI and CCI, we've talked about, this gets really bullish when the RSI gets above 60, right? That's when we are now for sure kind of feeling pretty good. Get above 60 and stay above 60, sorry. The QQQ has gotten above 60. We didn't get above 200 here, but the QQQ has gotten above 60. So now the question is, will it stay here, or is this going to be kind of a false signal? Again, you look at like the Russell 2000, and it's just flirting with getting above 50. And has a very good chance of rolling back over from that. And the RSI, CCI also not getting above 200 either. And of course the SPX, same thing, right? Not quite getting above 50, but not quite getting above 60. And then of course the Dow Jones Industrial Average, same as the S&P, not quite above 60. So not quite feeling pretty confident yet about this trend change. Of course the sorry, not the linear regression. I wanted to look at the Ichimoku Cloud. You take a look at the QQQ. Again, breaking through that cloud. But you can see how we can break back down below the cloud pretty quick if this is indeed false move. But it is a strong trend. We are back to above 5, above 80. So right now, the Qs have a extremely strong trend. That usually leads to this type of move, generally speaking. So that's something to keep in mind about the markets. IWM, on the other hand, not so strong. It is above the blue line here, and it's above a rising green line, but well below the Ichimoku Cloud, and we actually still have a bearish trend. As bullish as this has been, we just don't have as strong of a bearish trend that we used to have. It's just a weak one now, but still bearish trend nonetheless. SPX doesn't quite look the same, but it is still below its Ichimoku Cloud, and would have to have a pretty decent drop to stay below the Ichimoku Cloud, because that can act as a resistance. So that's the type of drop that could be coming by the mid-April if we stay below. But it also has, it's above 80 on this trend strength, and it's almost above 5, it's above 4. So you're between moderate and very strong trend, bullish trends right now in the S&P 500 too. So here we are kind of stuck in the middle. Of course, your Dow Jones Industrial Average, not quite as strong as the S&P. So Dow Jones kind of in the middle between really strong QQQ, not very strong at all. Actually still pretty bearish Russell 2000, where are we at, and which one are we going to follow? Are we going to follow the Qs back up? Well, the last time we followed that very small cohort of stocks to the upside was the beginning of this year, and that didn't really work out too well when other risk asset classes didn't quite follow along. All right, before we move on to like different ratios and intermarket relationships that we typically talk about, other asset classes, and our trade idea, I did want to kind of take a quick pause and summarize our technical outlook. And obviously we've been very, very bullish here. We've been bullish heading into an options expiration, but not everything has been bullish. There's some huge discrepancies in some of these major averages in terms of how bullish we are or how bullish we're actually not. And so that kind of leads us to say, okay, which one, what does it tell us? And, again, the track record of this leadership, and I'm going to show you a few charts here in just a minute, of this leadership when it's concentrated within a few stocks, hasn't been good. It's been bullish, but it's led to a 34% decline and to recover a lot of that divergence in this past few weeks. All it needed was a catalyst to produce that. And boy, how did we ever get a catalyst? So again, with options expiration now behind us, as we've seen in the last two options expiration cycles, the February and the March expiration, what kind of move do we have coming out of this one? The last two have produced some pretty significant moves. So what kind of significant move could we have now with volatility still as high as it is? So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there on the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that either makes you a lot more bullish than I am here, or that's more bearish than I am? All right, so for those of you who follow me on Twitter, I did post this chart out. There's a couple of interesting charts. Here's another one from Dana Lyons here that talks about how the value to growth ratio is way back down to 1999 levels again. Another time when growth really took off, but that was also another time when the QQQs were so overbought. Like, no, I wouldn't say overbought, but were such a high level compared to small cap stocks, and they are again now. In fact, if you take a look at this chart, you can see we were on a pretty decent bullish trend. There's nothing wrong with that, of having a pretty decent bullish trend over the past few years, really since the November election, right? We had this kind of big drop in QQQ, but since the November election, we've had a good little run in QQQs. Pretty bullish, and typically at the end of bullish runs, you kind of get this parabolic move, bullish trends. You get this parabolic move. Well, look at that parabolic move. It's kind of hard not to get more parabolic than that. In fact, the RSI for that move got up to above 90, which is very high for RSI in a daily chart. And last time we had that was here in August 2011. And for the next couple of years, for the next couple of 2+ years, about 2.5 years, QQQ struggled to gain any traction against small caps. And there's a lot of volatility. There were some ups and downs. The markets, they had a really good 2013, but it was small caps that led the way higher there. We weren't as bullish in the stock market over such a long period as we are now, with QQQ leading the way higher. We had a little bit of some bullishness here at the beginning of 2018, and then again here in August of 2018, we had a decent run. Where the stock market kind of peaked, at least risk appetite peaked, because that's where international stocks rolled over. This is where crude oil and yields, and they're all still down, well below those highs. But the stock market's not. The S&P specifically is not, because of this small concentrated of mega cap names, as well as other large cap, again, Nasdaq 100 type names. If you take a look here at, like, for example, the Russell 2000, if I go out to the this chart here and I go out to, we've got it up there. So let's pull up Russell 2000. Again, there's that January peak where all these international equities rolled over. And then here's the peak, is actually in October, where crude oil and yields peaked and they rolled over. But you can see this about the time where also economic indicators rolled over at that time. The year-over-year growth rates for economic indicators rolled over. So like the economic surprise that I always share with you that has now fallen through like the lowest level on the chart. You can't, I mean, we can't even see where it's at because it's actually below 100, negative 120. That's how it was, 129, negative 129. And again, August 2018 is when we went below zero here on this growth rate. And January of 2018 is when we peaked here. So we had a pretty decent run going into the beginning of this year. But obviously since then, we've really come down from an economic growth standpoint. Of course, we're at minus 64, which is not unheard of on this chart. And really, negative 120 wasn't unheard of either. This is a credit crisis in 2011. But minus 64 is also about 2011 low points. And even 2012 was close to those levels. And 2008 actually got worse. And 2008 was pretty bad here as well on the economic surprise index. But again, you can see once that surprise index went negative, that's about right here, and all those year-over-year growth rates on on all these economic indicators kind of peaked and rolled over in October and September and August of 2018, and then you can see we're not anywhere close to those highs on the Russell 2000. But if you look at like QQQ, we are well above those highs. Right, well above those October high points already. I mean, we had come down and we're testing a little bit, but now with this rally, remember we're up here now, 215. We're actually at that high point, 215 here. That's where we're at right now, well above those highs. So big divergence, and a very small, limited handful of stocks is kind of driving a lot of this action here. So if we're going to be bullish on anything, we know what to be bullish on. That this is the market leadership. It's what we want to stay in. That's the reason why we did Amgen the other day for a bullish trade. These are the types of stocks we want to do if we're going to be bullish, that we're going to be bullish on. Let's take a look at the asset class chart and see how that fared here this week. Bear with me one second and change the time frame here to this week. And you see S&P 500 led the way higher. Nice good gain on the S&P, 3% gain. Interestingly enough, emerging markets were also up and long-term bonds were up. So that's not really the typical time frame to see both of those. Gold dropping down, real estate was down, small cap stocks, look how bearish they were. And they had a good day today, but still finishing the week down, which shows, again, the discrepancy here. And of course, crude oil, as measured by USO, is falling down. Now, there's some differences in the charts here in terms of the futures contracts. Because if you take a look at, like, if I were to pull up here, crude oil will come back to FedEx here in just a second. But if you were to take a look at the different contracts for crude oil, you can see, these further out in time, some of these are pretty. We're actually pretty bullish today, and we're up at $32, $31. But this front month contract, it's only got 4 days left, so that's why we've kind of had a shift here. Crude oil, if I were to look at its chart, you can see the shift back up to $25 because that's the active contract right now. If I were to show you this market forecast chart and pull up, there's the shift, right, where we shifted from the contract that's now only $18 all the way up to one that's $25. So a big kind of jump, but keep in mind that you can see here that it actually says when this is adjusted for that continuous contract, we're actually down at 1.5%. And USO tries to do that. In USO, you can see that how it went down 3% and still way down here to these lows. So we're still pretty darn bearish on crude, and we're still pretty darn bearish on yields. We had a little bit of a bullish candle today, and a bullish move was about 7%, but we're still at 6.5% on yields, and still got the dark pink shading and the red line. So we're getting closer to where if we get a good move, then we can change to a dark green shading and a green line kind of at the same time. That's the ideal scenario for getting a reversal. So we're getting closer to that scenario being a likelihood. We're just obviously not there yet right now. But again, if you take a look at a small segment, we actually do have that, right? Dark green shading and a green line. So you see the discrepancy in the markets when you look at different risk asset classes and you put them in comparison with each other here, and you see, okay, you know, even just comparing QQQ to the Russell 2000 here, there's the drop. They kind of both drop the same on a logarithmic chart, mind you, but they both kind of drop the same. But then you can see we rallied up a little bit the same, pulled back down pretty much the same, and then I have rallied a lot more lately than we have on the Russell 2000. That's the Russell, of course. If you take a look at crude oil, you see a similar scenario. Sorry, crude oil. There we go. You see a similar scenario, drop down. You can see the divergence there. We were already dropping here, but when we bounced up, it was a much higher low point. Then it fell, crude oil fell, same as this was QQQ, mind you. We bounced up, but crude oil didn't. It went down to a lower low on that bounce. And then you can see the kind of negative correlation. It pulled back, crude oil bounced. We could take off, and you can kind of see, again, remember that's, you have to look at actually USO because of here, let's look at USO instead. And you can see the difference, the divergence that's still showing on crude. I mean, that's a humongous divergence. And then finally you look at TNX, which is the 10-year yield. And same thing, we had already started to come down. There's your divergence. QQQ led the way higher. And then you can see a divergence again, an extreme divergence again. That divergence didn't play out very well. And, you know, again, maybe without the price war in crude oil between Saudi Arabia and Russia, maybe we stop right here. And that's all the pullback we get in the market as a whole. The price war exacerbated this. And since that's been taken care of, and now the coronavirus being the other, you know, that was this catalyst. That's kind of being taken care of, supposedly. We've had a good rally, but these other markets are not. These other markets are not like confirming that those expectations from what this specific market is telling us, specifically these large cap Nasdaq names. I mean, again, look at Dow Jones Industrial Average here, which is more blue chip. Excuse me. Have been tracking pretty well until this past week. This past week, the Nasdaq has taken off, and the Dow has too, but not to the same extent. So again, a little bit of a divergence here. Whereas, and you can see too, the Dow Jones Industrial Average kind of started off higher, and from this level, you can see, again, this is a logarithmic chart. You can see the return it had. But from this level, the Nasdaq had a much bigger return here. In fact, much bigger return here. And again, we saw how that divergence rectified itself. Now let's look at the sector rotation. An interesting development on the sector rotation here. Let's just look at, today. Let's go to today's sector right there. And go out to a 10-minute chart. And look at the week that was. So staples and healthcare, not surprising how bullish they were. They're continuing to move their way up higher here. But you also see discretionary, technology, communication services. Those are your big, large cap Nasdaq names. They're doing very, very well today. I did want to show you this this list of the Nasdaq 100 names and how close they are to their 52-week highs as a list. And if I were to, let's see, where's my, is right here. I'll move this over here. So here's the Nasdaq 100 names, and let's actually get rid of the weekly, sorry. There we go. So about 193 stocks that kind of that are not too cheap, not too small, and have some liquidity in terms of trading volume. If you take a look at how close they are to their 52-week highs here, give it a second for the rest of these to load up. There's a couple of them that I haven't loaded, but you can see a lot of these names are really darn close. 100% would be at the 52-week high or close to it. A lot of healthcare names, a lot of information technology, communication services names. A lot of these, you know, when you talk about like 3/4 of the way up to the 52-week high or not, a lot of these are more than 75% higher. There's only a small chunk that are below 75%. There's a really small chunk that's below 50% that are more than halfway down from their 52-week high. That being obviously airlines and anything just consumer discretionary that has to do with travel or airlines. They're all down here. The rest of these are pretty darn bullish. So there's not a whole lot of value in these names, and they are doing really well, and they've had a really good week this week. Some of them, look at their PPOs. There's a lot of strong positive numbers in here, and some pretty decent returns, especially in the healthcare area here today. But not everything looks as pretty, and that's going to bring us to our trade idea. Let's take a look at FedEx as our trade idea of the day. So let's take a look first at its market forecast chart. And you can see, unlike the Nasdaq Composite, which we are above the moving average, and it's got dark green shading, but unlike the Nasdaq, which is way up here, FedEx is not. It's barely above here. It's testing these highs, like the Russell 2000 is. If you take a look at its chart, its long-term chart here, you can see that FedEx is still below its 50-day moving average and not getting closes. We still haven't closed above any of these high points on these bullish Hakunashi candles. If you take a look at its Bollinger Bands, you can see it's also still got pretty strong resistance levels. Here above us, there is a gap of volume that would take us up a little bit higher, but there's also very little volume down below us too here. And you can see how we had a nice pop up and we've been grinding. In fact, that grinding action, you can see it here on the Ichimoku Cloud, similar again to what we saw in the S&P, where there's the move that it would take to stay below the cloud, and can stay below the cloud pretty easily there. And the DMI is also not confirming this bullish bounce. In fact, the positive directional index just barely got above 20 here. So as bullish as we've been, and there is a bullish crossover, the ADX is really falling down, and the positive just can't get going. The negative is just dipping below 20 and can pop back up pretty easily. From a 3 green line standpoint, which is the other thing we look at here, it's got a convergence. That MACD histogram had a nice little pop here to get us up to the 30, and we got above the 30, but we're not really going anywhere now. And the stochastics is falling, and it's below its moving average, which means that buyers aren't nearly as in control as they were. So it gives us an opportunity for a bearish trade, as always, especially with April expiration closing and freeing up a lot of those bearish trades that we made there. Obviously we had, in our class portfolio, we had a lot of bullish deltas already, so that gave us a lot of flexibility to make some bearish trades. Well, that's the same flexibility we have now. So with FDX, now a lot of those were taken off the table. FDX, what we did was we bought the 115 out of the money call, and then we sold the 110 call as well. Again, we did this before the market closed at 3:30 Eastern Time during our Market Outlook live session. You can see we're already up a little bit since we got into this trade. But allows us to go down towards 110, and if we stay down there, great. We get a good return, almost $2,000 for about $500 of risk. And if we don't, if we break out to the upside, then I'll end up taking probably about, at least at the worst, $560 of loss, but ideally probably about $280 of loss or less if this max gain falls out of the window and we break out into that volume gap to the upside. All right, so that does us for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forum where you can post any questions with any threads or post any new thread, with any questions or comments you have about today's video. And if you see anybody else's thread that you want to comment on, you can reply to anybody else's thread too. And let's keep this conversation going over the weekend. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between videos, and join our Market Outlook Facebook group that we've created, as well as our website at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.